Okay, guys, so this is day 15 of this YouTube mentorship. I'm glad to still have you guys. For the past 2 weeks now, we have been on a steady back-to-back class. I want to really appreciate you guys for um being part of this. So let's us go into the business of the day. Right, so today we're going to be talking about order blocks. Right, we're going to talk about order blocks. That will be our topic for today. Right. Now, there has been several definitions of order blocks, several ways people view order blocks, all right? And, order blocks is actually identical to order flow. I've taught you guys about order flow, but when it comes to order block, you're more precise. Remember, watch the teaching I made on order flow. So in this 22 days YouTube mentorship, in this playlist as well, just check the playlist, you'll find it there, order flow, institutional order flow. So order block is kind of in that light, but it's more precise. Now, ICT defines order block, which I'll also give you the definition as well, as the change in the state of price delivery, right? It defines that was the change in the state of price delivery. I'm trying to get my text to on board. So it defines that was a change in the state of price delivery. Why? Since acting up. It's not letting me type in. Right, so change state of price delivery. So this is how ICT defines order block. All right. And I will go with this definition as well. So what this definition is trying to say is that an order block is a change in the, let's say, momentum of the market. That means market was delivering to the upside and then it suddenly started delivering to the downside. So that change in the delivery of price, right? Price was delivering to the upside and then somewhere around there was a turn. So that change in the state of price delivery, that is what we refer to as an order block. Now, let me point this fact out. This is a fact many of you mix up. An order block can consist of a series of candles. And this is one mistake that some people make. Some people always call order block the last up candle, last down candle. I know some of you guys know what an order block is, but today we have to just debunk that controversy, right? It can consist of a series of candles. Why is that so? Because this is a candle on a higher time frame, right? This can be a candle, maybe the 1 hour chart. And if you view this 1 hour chart, right, this area on the 15-minute chart, obviously this 1 hour candle is going to be what? Like 4 candles, right? So if you view the 15-minute chart, which is the breakdown of a 1 hour candle into 4 places, you see maybe the market creating a series of 4 different candles, right? You can see 4 different candles inside this 1 hour candle, right? You can see 4 different candles inside this one candle. So now, would you say that because this is the 15-minute chart, then automatically the order block has moved from being this whole candle towards the last one? No, right? So order blocks are not necessarily the last up or down candle. It can consist of a series of candles. Now, I will teach you guys practically how you can be able to be more precise with knowing the particular point to pick. Right, let me open up trading view in another side. Let me open up trading view in another side. All right. So why that loads up? So an order block can consist of a series of candles, right? It's not necessarily that last up candle, right? So typically, another point you should also know that the body of the order block, let's say the open of the order block, right? Let's say the so notice that so the open and the midpoint of an OB carries most of the volume, right? So the open of the that is the open price and the midpoint of an order block carries most of the volume. That means the open of it or the midpoint. So if it's like maybe 4 candles, just measure that and mark 50% of it. So the open price of this candle, in every order block, you usually have what the high of the wick of the candle, and then you have what the lower wick, right? So you have the lower wick now. So the area that carries the most volume is what the open price, which is here. So this is the open price of the order block, or the midpoint, which is what 50%. And when you're measuring 50% of it, you're measuring the bodies most likely. Or you can say you just do something like this, and then you get what the 50% of it. This is 50%. So either the open or the 50%. This is how you're able to get the most sensitive part of the other block, which is what the open or what the 50% of it. Right. So you have to be mindful of that. That is why some people, when they take their trades, they usually put their stop loss. Some people do not all. Some people put their stop loss. If maybe they're buying the other block, they put their stop, maybe they can put the entry as maybe somewhere around there, and then they put their stop loss above the 50% of the account. If they want to sell shorts, they'll put the stop loss maybe a bit above the 50% because they don't expect price to cross that. So maybe they take it at the open now. Right. This, if they are going short, it's going to be the open, right? So they'll likely put the stop loss above the 50% to avoid, because this is where most of the volume, whereas price should not go above this, right? But to be conservative, always use the high of the candle to be very conservative, right? So now we're not talking about entries yet. I'm just trying to let you guys understand something, that the midpoint of another block and the open of the other block carries most of the volatility, right? So that being said, let us talk more about order blocks. So order blocks helps you to know where the change in the state of price delivery happened, and we expect price to mitigate order blocks. So our entries are usually when price comes back to tap into the order block. Now, when is an order block printed? An order block is printed simply when price closes below the candle. So if we have an order block now, and then market was bullish, it's not that price was bullish. Right, price was given a bullish market, and then it created this order block now. Right, price was bullish, and then we had this other block. The market was bullish, then we had this other block. Right, we had that other block there. So how does this now become more valid? This other block will become valid when price closes below it. That's where we usually pay attention. So if price closes below the close price of this candle, assuming that maybe this candle now may be opened and then it now closes clearly below the candle, right? This is what we call an order block. As closes below this candle, order blocks low, it immediately we view this as what an order block. So you can simply extend the opening time. So expecting price to come back and tap into the order block, right? That's the low of the order block. So this is what we call a bearish order block, because it's happened and then price closed below. So you cannot expect price to come back to that order block there, and then you look for a sell opportunity. So once price closes below the close price of order block, automatically this now becomes what an order block, right? So when you see price close below it, right, it doesn't necessarily need to break structure, right? This is one mistake that you guys also make. You guys are always like, price must, it must break structure, like it must print order block and then break structure. That's not necessarily correct, right? Once price makes this and then closes below the candle, that's an order block. It doesn't need to come take out structure, right? Note that an order block can be printed without taking out structure. So it can just be an immediate return. Price close below and then come back immediately, right? So take note of that. So it mustn't be after, you mustn't play it after market takes out structure. Price cannot print order block here and then come back to the other block and then drop off, right? So what really sponsors this kind of trading is when you see a liquidity run. If price run liquidity now and then you see this other block prints, like price close below it, and then you can see this, you can still take a shot here. Price doesn't need to come all the way down here to break structure first. It doesn't need to, right? It doesn't really need to do that, right? So once price takes liquidity and make an order block, you can look for it, right? That's what makes a high probability, right? The fact that liquidity was taken, right? But if you don't see this happening in the middle of the chart, it can be just a continuation. But you want to see this has happened at specific zones. So the price runs liquidity and then makes an order block. This is because of a valid one. All right. So that is basically how you're able to pinpoint your order block, right? So let's just look at some examples of order blocks on our charts. Let's look at GBPUSD. On the 2-hour chart, let us quickly look at GBPUSD. All right, so let's take all this fun stuff out. All right, so can you see order block here? What happened there? Price around liquidity. Can you see where price closed below it? So price closed below the order block here. Let's take out all these drawings. And let's look at this Asian too. So you can see how price ran above this high, taking out this liquidity. Right, this is another block that was printed, and I can see how price came back into it. So this is the open price of the candle here. This is it. This is open price. You can see how price came back to the other block, and what happened is it dropped off. Right, that is it. So other block doesn't necessarily need to break structure before you can call it another block, right? Once price run liquidity and then makes this big candle, look at a bullish block here. You can see how price ran this low, and then what happened? We saw what price coming back towards the open price of the other block. Can you see that? That's another block, right? So you can see how this is occur as well. What again? Say price ran, although this was not very nice, but price ran this. What happened again? Price made an inducement here. You can see this inducement that was created here. Right? See this inducement that was created just before the other block was printed. You can see this inducement here, right? And then what happened? Price came finally to the open of the other block. Can you see that? So you can see how this is occur. Right, these are other blocks, right? See another other block. Although price not really do well, but look at another other block here. This is the open, the close price. You can see our price kind of pushed down a bit, but because this market was bullish, that's why. So market was bullish. And why? How do you know it's bullish? Because it failed to break this low. It respected this low. You know, higher high, higher low, higher high, higher low. So it didn't go breach this low. That means this low is protected. So that means bullish continuation toward the upside, right? That's how other blocks print. It prints that way, right? So you can see other blocks printing. All right, now this is it. You can see another other block here. You can see how this kind of printed last down candle, and then that. Now let us also filter this thing out. How do we know other blocks are high probability? How do we pinpoint other blocks are high probability? So high probability other blocks because other blocks print almost everywhere. So we want to focus on what are high probability, right? So high probability other block probability. So they have few features. Number one, they have what they occur after. You have to see what the liquidity run, right? The liquidity sweep. Let's say it's a liquidity sweep. Market sweep liquidity, just like in this example here. That example I showed you guys, the first one. Right, this is it. That's what makes it high probability. And the last thing that makes other block high probability is what? Presence of an imbalance, right? It's the presence of a fair value gap, right? Or slash imbalance. So this also makes it high probability. You can see imbalance after the other block is printed. That means what? There is what? So you can see where is an imbalance. Can you see this imbalance was printed there? Right. So this makes it a valid one. So when market creates an imbalance during the formation of an order block, right, it makes it high probability as well. You can see all these imbalances here and all of those forms. Now, if you look very carefully here, you can see obviously we have another order block here. Another one. You can see this last up candle here. This is an order block as well. You can see these imbalances. Although it didn't really sweep liquidity, but it's also a valid one, right? So it must not have all the functions. You can just have one of them, and then we can continue with that. So another thing that you must see in another block to make it valid is number 3. I think I'll give you guys 3. The third one you must see what you must see how do I put displacement? Yeah, this is a word. What do I mean by displacement? I'm talking about price moving aggressively from the other block. So you can see how as price broke down, it moved aggressively below the other block. I don't see price move aggressively away from it and then return. Right? You can see this bullish one printed there. You can see how price created the other block. You can see it moved aggressively away from the other block before coming back. So when you say price move aggressively away, you can see this other block printed there. You can see how the market made an imbalance here. You can see this aggressive move away from the other block. So you want to see markets move aggressively away before returning back to the other block. So that means that there is volume. Right? The volume is what is sending price away quickly. Once the price run away from the other block and then return, you can see another block here. Can see how price made this order block because it's aggressive run away. Although price has not come back here, but this is a very order block because you can see how it swept kind of liquidity here. You can see the imbalance that's inside there. You can see the imbalance here between these two candles. And then you can see what this aggressive move away. That's what makes another block very valid. Right? Those aggressive moves, aggressive run away. Right? So this is a call on repeat. Right? You can see how this happened as well. You blow liquidity, and then although this is not really if you check the lower time frame, you will see this more clearly. Check maybe the 1 hour chart. Oh god, I don't want to go back there. So if you get me to the 1 hour chart, you will see I had to refine this. Right? So there was no imbalance here, so it might ignore that, right? So but you can see that liquidity was run through. So note that it can have one, two, or all. It must not have all at once. Sometimes all about don't make imbalances, but they create liquidity sweep and displacement, and that can still go. But it doesn't always have to create an imbalance. It doesn't always have to. Right? You can see this other block here was printed. You can see it's aggressive run away from it. So price came back here, tapped into the open of the other block, which is here. Right, and then now another point you know that when other block has sometimes you can view other block this way, like the whole move down. Now, the instances where you choose this, you look at it, the instances where you choose other block this way, so when the wick is a bit long. Sometimes when the wick is a bit long, you can just choose to play the whole move down. Like this is where the move started. Because if you go to 1 hour chart, this will obviously be a candle. So sometimes to avoid missing trades, you can just choose to play the high of the other block, right? You can also play the high of it, right? Instead of always choosing the open. But most of the volatilities are the open, right? But price can still choose to reject from the high. Sometimes you can choose to just play of the high, but the open is where most of the volatility rests, right? So you can see that. So that's how other blocks print. Trying to look for more examples of this. This is a 2 hour chart. Maybe if I went to the 15 minutes, I'd have seen more of this. So let's go to US30 and see if you can see something maybe on the 30-minute charts. I want to show you guys a lot of examples today, so you guys can understand what I'm teaching. All right, so this is a US30 chart. So you can see how these things have been happening on repeat. So you can see how price went above this other block. You can see the same balance here. You can see how price went above it. All right, not really aggressively away, but he went above the other block and then came back. You can see the same balance here. He played the same balance which was inside the other block. Now that was a very nice one. All right, so you can see this one as well. This is another block here, but it did not hold because market was what? Reversing. Market already took a liquidity here, and then you can see market was reversing, kind of played around a bit, and then they give up the ghost. All right, so that's how this is occur. All right, so this is occur every single time. Right, so look at this other blocker. So you can see how price made this candle. Kasa market went above it and then came back to this other block here. Kasa price pushed above that last down candle and then came back to it. That's another block. Right, you can see all printed that this market pushed away from it and then came back into it. You can see this aggressive 1, 2, 3 candles away. The market came back to tap it. This week of this candle came back to tap the other block for the ones sending price higher. Right, so you can see another other block here. Although there was no imbalance here, I can see that this was mitigated because after this other block printed, price came back to it. So this other block was already mitigated there. So if you were watching this market, maybe were bearish, market broke below it and then came back here. That would have been a nice shot. Although there was no imbalance here, but there was a kind of liquidity run and there was also what? A displacement. Market went aggressively below the candle. So once markets grow aggressively below the candle or below or above, depending on the scenario, and they want to see price return to that other block. All right. So let's check Euro USD. All right. Yeah. All right. So same thing. This is Euro USD. So you can see how Euro USD is also making its own move. Right. Look at this other block here. See this. Right. Brackets came very close. It tapped it a bit and then dropped off. I see another block here. This one did not hold, and then all of this front. So look at other block here. Market made this other block, took a liquidity, and then was broke below the candle. So if you are selling this, do a big short, very nice sell. Although there was no imbalance, remember I told you guys, it can have 1, 2, or at least let's say have at least one of this either liquidity sweep, imbalance, or displacement. Right, it has to have one or at least one of them to the high probability. Right, you can see how price got to liquidity and then it's made a displacement just below the candle. Market has to close clearly above the below the candle. It went below the candle very clearly, and you can see how the market came back to run to the downside. And then finally, also add one last thing to this list. And the first thing which I do not add is what? Let me add that fourth thing before you guys will get carried away, right? Number 4 is that it must be in line with the trend. So you must consider the trend of the market. Don't be try to buy other blocks when the market is bearish. So it has to be in line with the trend, right? It has to be in line with the trend. Not that you're going to buy other blocks. This market was heavy bearish. You can see the market was heavy bearish. You can see this big bearish move here. Right. So this was just a liquidity grab. Markets now create its other block and continue to the downside, right? So you have to be very mindful of that. Always be mindful of the trend. Is the market trending downwards? So it won't be on the wrong side of the market, right? To avoid being caught up in the wrong side of the market, always consider the trend. Is the market bullish? Is the market bearish? And all of those fun stuff, right? So that's basically how you're able to pick up other blocks that are nice. You can see the other block here. It took out this liquidity, and then you can see this to the downside. So price came back. You can see the open of the candle here. After price broke below, came back, sold off a bit. The market was overall bullish, but this was a very nice short scalping opportunity. If you caught it, you can see so that block, this one as well. Because the market took out liquidity and then was closed below it. The next candle came back, tapped into it. This was a nice sell. If you catch this, was a very nice sell and then down, right? See so that block as well. Market went above it. And this is another block here. Market closed above it and then came back, tapped into it and then was regime bullish. So market was bullish in this scenario and other forex fund stuff, right? This is how you pick other block, right? I'm not showing you guys how to identify them. I'm not talking about top-down analysis yet. So I see another one here. Market closed below the other block, came back, tapped it. So you can see the open on the other block here, right there. Right, right. Market, came here, tapped it, and then that is it. So this now explained is also in institutional candles. Institutional candles and other blocks are also similar, right? You can see how this took a liquidity, they came back there, and then all of this fun stuff, right? So the difference between an order block and institutional candle is that an institutional candle always takes the liquidity, while other block do not always take liquidity, right? There's not always, grab liquidity. It's not all the time. Like this another block now. There was no real liquidity grab here, right? Although you can see that is, we can see how markets came back to that candle. You can see how price found it difficult to break through. Market was just, finding difficult to break through. Before finding what broke through, right? So these are other blocks you can look at, right? Look at another block here. You can see this one here. Although there was no imbalance here, that was left, but price, kind of played around it and then dropped off, right? You can see, you also have to consider what the market is doing. It's not fail proof. Other block here, market closed below this candle, came back, tapped into it, and then what dropped off. And why do we consider this? Because of what this liquidity grab here, right? So market closed below the other block, right? There was an imbalance there. Can you see imbalance as well? This tiny imbalance between these two candles there, right? The market came. Let me zoom it so you guys can see it. So look very clearly, see the imbalance here between this candle and this. Let me just back it out so you guys can see what I'm talking about. You can see this high probability now. This imbalance there. Market took a liquidity and then entered it. That was your sell, right? Price doesn't take a structure when you're considering that blocks. But once liquidity is taken, you can consider that as another block, right? So that's a very nice one there. Right, so that is it. So that is it. So then you can also add another one. Another thing that makes probability other block high probability is what when you see what an imbalance before the other block, right? If you see an imbalance before other, so that inducement. So if you see an inducement before an other block, it's also very nice one. If you see an inducement, right, before the other block, that's a nice one. So what do I mean? So if you have another block now, right, you have another block now, and if you see some kind of inducement before it, like kind of false high before it, that makes it high probability, right? I've not picked an example with that. So let us quickly for an example with that. With an inducement before it. Right, let's look at another one that had an inducement before it. Right, let us look back in time. Right, this one blasted through and then continued higher. That is fine. I'm trying to look for another block with an inducement before it, so you can get a better example of a better picture of what I'm saying. I see other block here. Took liquidity and then was close below. You can see if you took a short here, having a very nice rundown, right? So be mindful of that. So look at this other block now. You can see this inducement here. See inducements resting there. You can see this other block here, which was not happening. You can see this other block here, other block, and then you can see the inducement that created before it. So that was the nice one there. inducement before the order block, and then you can see imbalance here. So that was an extreme one, very nice example as well. So do yourself a favor and back test and study these things. Remember what are these 4 things. These are the 5 things that really make a probability a higher block worth trading, right? You have to at least get at least two of them, right? At least 2 examples. You can see this one as well. You can see this inducement here, and then you can see what the other block down there, right? This other block. You can see how it was very, very precise, right? Very nice. Took out the inducement and they will tap the other block, and they can see how price ran to the upside. And this was in line with the trend of the market, right? This was the trend of the market. Look at that one here. You can see this inducement here. Because these are the last inducement. Right? You can see the other block that was printed there, which has not been tapped into. Note that this was not tapped into already, right? So you can see how price, came there. Nice one. So now, note something. An order block can be used 2 times, right? Like this one here, price kind of tapped into it the first time and then it went away and then came back second time. So order block can be used 2 times, right? It can be used 2 times. It can even be used 3 times. It's not just once, right? So now price can mitigate another block 2 or 3 times. So I can see how this one, markets actually came back there, but there was no really displacement away from it. So once market displaced away from it before coming back, right? Because markets came back there and then pushed away, right? So this one happened. You can see the liquidity grab here. Remember what makes the high probability? Liquidity grab was there. You can see imbalance was also there. You can see this imbalance inside here. You can see inducement here. So this one has about 3 of the list. So we had a liquidity sweep, we had imbalance, we had displacement, we had inducement. In fact, we had all 5. This was a bearish market. You can see the trend. Market was breaking lows. So this was a very, very high probability that fits with what all the 5 criteria. So always just note this out. So if you want, if you got this, just type out the 5 things that make order block high probability. Type it out. Number 1, liquidity sweep. Number 2, fair value gap presence. 3, displacement. 4, trend. 5, inducement. So if you have these things, these are the things that you look at to know if an order block should be taken. Right? Should it be taken? Right? And also note that the extreme order blocks have more probability. That means the order block, what do you have here? We have another order block here, right? So note that the order block at the extreme are more likely to hold. So also note that too, extreme order blocks are more high probability than the ones that are in between. So the ones that are at the extreme, and this is the extreme one now. Look at this range here. This is the extreme order block, the extreme one that has not been mitigated. So this was the extreme one. This was in between. This was the extreme one. That was what makes the high probability. So always note the extreme order block. That's what we want to be using. Extreme order block. Extreme. I can see this one as well. Markets closed clearly below it. What do we see here? Liquidity grab. Is this there? Yes. Price was closed below the other block. So you can mark the other block open here. This is a very nice one. Right. Is there any imbalance here? Yes. So you can see how, was there displacement? Yes. Markets displaced below this low. Markets came back, tapped into it. Right. Took out this inducement. Look at see inducement here. It was beautiful. So took out this inducement. And then what happened? It entered this imbalance here. If you sold there, that would have been nice. So maybe sell target or this low here. Right. So that was very nice also. If you guys understand it, just type I understand. Right. So use your time to go through examples to have a better understanding of what I just discussed here. So if you want to join our pay group, use the link in the description for a 20% discount. 20% discount on our pay mentorship. If you want to use the code June to join us, right? So have a wonderful day. Cheers and God bless.